Welcome to this explainer, where we're digging into the wild, extreme volatility of meme-to-utility tokens. You know the feeling, right? You watch a token absolutely skyrocket, and the exact second you finally decide to buy in, boom, it crashes. It honestly feels like the market is uniquely rigged against you. Well, today, let's dive into the central paradox using BUILDon as our real-time case study. We're going to break down exactly how massive market players manipulate retail emotions, and much more importantly, how you can spot their traps before they spring. Take BUILDon, for example. It's an AI mascot token built natively on the BNB chain, and it recently experienced a staggering 279% surge in just 7 days. I mean, it was an absolute frenzy. During that stretch, this token was massively outperforming heavyweights like Bitcoin and Ethereum. Driven by its association with a newly developing stablecoin ecosystem, the narrative was incredibly infectious. It looked like the ultimate breakout, pulling in huge amounts of capital and completely dominating the social media chatter across the crypto space. But almost immediately after peaking, the floor just completely fell out. The price crashed 14% in a mere 24 hours. But honestly, the real story here isn't just the price drop. It's the fact that trading volumes suffered a massive 64% collapse. It completely evaporated down to $21.3 million. This wasn't some slow, gradual bleed. This was a sudden, violent halt in speculative demand. And that severe pressure pushed the token dangerously close to its critical 30-cent support level, basically leaving late buyers completely stranded. Now, if you look at the on-chain data here, notice the stark divergence. While the price was plummeting, retail traders, everyday investors, were actively buying the dip, desperately hoping for a quick bounce. But the whales, those large institutional players holding massive amounts of capital, they had flipped entirely bearish. They were the ones selling right into that retail buying pressure. And guys, this divergence isn't a coincidence. It's a meticulously crafted scenario designed to transfer wealth from the impatient to the patient. To really understand why this divergence is happening, we need to demystify the mechanical operators who basically control the crypto wilds. Let's talk about liquidity traps. You see, whales can't just click buy or sell on their massive orders without wildly shifting the price against themselves. They literally need a huge pool of opposing orders to get the job done. So what do? They intentionally push prices into obvious support or resistance zones to trigger retail stop losses and breakout orders. They use your panic or your FOMO to generate the exact liquidity they need to quietly fill their own massive positions. And these operators, they don't just guess. They rely on a highly specific playbook made up of 5 clever traps. First, you've got fake breakouts, where they push the price just above resistance to bait retail buyers before violently reversing. Then there are stop hunts, which are sharp spikes designed purely to trigger liquidation clusters. Next are range traps, keeping traders chopping back and forth in tight, frustrating channels. You also have inducement moves, these slow, enticing creeps into key levels to tempt weak entries. And finally, news manipulation, where they exploit sudden hype, like an ETF rumor or a project partnership, just to dump their bags on excited retail buyers. This brilliantly illustrates the mindset shift required to actually survive in this market. If you want to stop getting caught in these traps, you have to stop chasing green candles and start waiting for the crowd to commit first. When you see a sudden pump, don't ask if it's going to the moon. Ask yourself, who is on the other side of this trade? Who actually benefits from me buying right now? It absolutely changes the entire way you look at a chart. Section 1. Analyzing the BUILDon drop. Technicals versus reality. Applying this market maker theory to BUILDon's recent rejection at the 64.5-cent resistance level, let's look at the daily technical ratings provided by BitGet. The moving averages paint a devastatingly clear picture. Notice the 13 sell signals, 2 neutral and absolutely 0 buy signals. The momentum indicators, the trend lines, everything flipped to a strong sell. So that breakout above 60 cents, it wasn't the start of a new run at all. It was a textbook fake breakout. The whales pushed it just high enough to attract the momentum traders, and then immediately dumped their positions, completely crushing the technical structure. Furthermore, when we peek under the hood at the underlying tokenomics, we uncover a massive token concentration risk. Approximately 20% of BUILDon is held by whales. When a tiny group holds that much supply against an 80% retail public, it creates the absolute perfect environment for those inducement moves and stop hunts we just talked about. They literally have the capital to physically move the market and paint the chart however they want, just to trick that 80% majority. Section 2. The fundamentals illusion, roadmap versus red flags. Now, a token's price action doesn't happen in a vacuum, right? BUILDon presents itself not just as a meme, but as a serious utility project. And to their credit, the project is actively trying to transition from a simple meme coin into a complex DeFi infrastructure hub. Their roadmap is heavy on utility. In 2025, they're slated to launch a funding launchpad for their ecosystem. Through 2025 and 2026, they're building deep trading pair integration with the USD1 stablecoin. And by 2026, they plan to launch a beta for a cross-chain swap tool, aiming to allow seamless stablecoin payments across different blockchains. It really sounds like a powerhouse of development. However, we have to juxtapose this impressive roadmap with some massive red flags. This is exactly where the illusion becomes apparent. Despite all these complex DeFi tools they're supposedly building, there is a complete absence of an accessible white paper. You literally cannot verify the technical architecture. Combine that with an entirely anonymous development team and unclear project leadership, and you have a recipe for extreme risk. You're essentially trusting a faceless entity to manage cross-chain financial infrastructure without them providing the basic, fundamental documentation to prove it actually works. Additionally, the project's ecosystem is anchored to the USD1 stablecoin, which is closely tied to World Liberty Financial and the Trump family. Now, purely from a market dynamics perspective, this connection creates incredible narrative momentum and retail hype. It's highly visible. But equally, it introduces the very real threat of sudden, intense regulatory scrutiny. Politically linked crypto projects are historically lightning rods for regulatory clampdowns, which adds a layer of systemic risk completely independent of what the token's technical chart is doing. Section 3. Surviving the Crypto Wilds, the Retail Traders Protocol. So, with all these conflicting signals, the massive price swings, the whale manipulation, the missing white papers, and those looming regulatory risks, how do you actually protect your capital in a market like this? Well, by following a concrete 4-step survival protocol, you can actually turn these market maker traps into predictable opportunities. Step 1. Screen for traps by marking obvious support and resistance liquidity zones on a 4-hour chart. Step 2. Detect the trap using on-balance volume, a metric tracking buying and selling pressure. If the price spikes into your zone but the volume is unusually low, watch out, it's a trap. Step 3, avoid trades that are stretched way too far from the VWAP, or volume-weighted average price. And step 4, always execute strict risk management by setting your stop losses based on the ATR, or average true range. This measures market volatility and keeps your stops out of those obvious hunting grounds. As BUILDon currently teeters right on the edge of its 30-cent support level, staring down the barrel of whale concentration and missing documentation, we have to ask ourselves one final vital question regarding its true utility versus speculative chaos. Will the actual real-world on-chain volume of their USD1 ecosystem grow fast enough to outpace the inevitable next wave of whale profit-taking? The answer to that will determine if this is the future of DeFi infrastructure or just another incredibly well-executed liquidity trap. Keep your eyes on the volume, and whatever you do, don't let the whales catch you sleeping.